Should you pay off your mortgage before retirement? Paying off your mortgage early is a hotly debated personal finance topic, both sides of the argument having strong feelings. When you purchase a home, your goal is to own it one day, and retirement seems like a reasonable target for paying off your mortgage. A simple internet search on the topic turns up all sorts of articles and opinions. If you bought or refinanced your home when you were in your mid-30s or older, you may likely find yourself heading into retirement with a mortgage, as you would have likely got a 30-year fixed-rate mortgage, as they're by far the most common choice for homeowners in the United States. According to a recent article on Fortune.com, fixed-rate loans account for about 92% of all mortgages in the United States. Now you've realized your final payment may not happen until after you're retired, so it's natural to wonder, should you pay off your mortgage before you retire, or just keep up with scheduled payments? While every retiree's situation is different, experts say clearing mortgage debt is preferable, but not always advised. There are pros and cons, as well as opportunity costs, to be considered. Are you ready to talk to someone about what role your home should play in your plans for retirement? If so, go to www.makeitpersonalpodcast to learn more or to schedule a no-obligation conversation with one of our advisors. Now back to the show. My name is Mark Zagurski, and I'm the Director of Strategy and Communication for Mutual of Omaha Advisors, a division of Mutual of Omaha. We understand that we're here for our customers and because of them, so every decision we make is with their best interests in mind. We have roughly 1,000 advisors located around the country, helping our clients to imagine, plan, and secure their financial futures each and every day. Conventional wisdom would say it's preferable to go into retirement without a mortgage, but conventional wisdom can be so conventional. According to a study from LendingTree.com, published in November 2024, paying off a mortgage before retirement age isn't feasible for everyone. In fact, more than 10.5 million housing units across the United States are owned by people 65 and older who still have mortgages. In this study, LendingTree analyzed the latest Census Bureau American Community Survey data and looked at the share of housing units with mortgages in each of the nation's 50 largest metro areas owned and occupied by people 65 and older. They found that nearly 20%, or 1 in 5, of all homes with mortgages in these metropolitan areas are owned by somebody 65 or older. There are many financial and emotional considerations when it comes to carrying a mortgage in retirement. How would paying off your mortgage early affect your retirement nest egg? Will you be able to afford a monthly payment once you retire? How will you feel about having debt and making monthly loan payments once you've stopped working? While there may be more, I can reasonably think of 4 reasons to pay off your mortgage before retirement and 4 reasons not to pay off your mortgage before retirement. The censors who get to review this will certainly love the idea of that balance. Let's start with the 4 reasons to pay off your mortgage before retirement. I mentioned it previously, peace of mind. No mortgage, less stress. It reduces your monthly expenses and gives you more flexibility. Number 2, lower monthly expenses. If you're on a fixed income, like Social Security or a pension, having fewer bills helps your money go further. Number 3, interest savings. Paying off your mortgage gives you a return equal to your interest rate that can be more appealing than market volatility. And the 4th reason to pay off your mortgage before retirement is housing security. Without a mortgage, you're less at risk to losing your home if money gets tight. All right, now let's go on to the 4 reasons not to pay off your mortgage before retirement. First up, low interest rates. If your mortgage rate is super low, your money might work harder elsewhere. Number 2, liquidity matters. If paying off the mortgage would drain your cash reserves, that could put you in a risky spot if you need emergency funds. Number 3, opportunity costs. If you still have time before retirement, investing extra cash in a 401k, IRA, or other retirement account might give you better returns. And 4th, tax considerations. If you're itemizing deductions and still getting a decent mortgage interest deduction, it could be worth keeping the mortgage longer. To pay off your mortgage or not to pay off your mortgage? That is the question. And the answer to the question is personal. In my personal situation, our house will be paid off in the next 5 years, though we've never paid any extra principal. We simply took advantage of refinancing opportunities over the years and made the choice that each time we refinanced, we lowered the duration of our loan. We purchased our home in 2010 with a 30-year fixed-rate mortgage. We refinanced when the opportunity presented itself and lowered our rate along with our term down to 20 years. We refinanced again and lowered our rate along with our term down to 10 years. Is there an opportunity cost? Absolutely. Do the same 4 pros and cons that we just discussed apply to us? Without a doubt. Sure, we could have reset to 30 years each time. We could have taken cash out at each refinance, though that would have increased the amount of the loan. We could have spent the difference from a lower monthly mortgage payment in an attempt to keep up with the Joneses. Instead of blindly resetting the term to 30 years each time, we opted to take advantage by shortening the term of our loan. For us, the biggest driver was peace of mind. That doesn't necessarily mean that that's the right choice for you. To me, there's another question out there looming when it comes to retirement. What role should housing wealth play in your retirement plan? A home can be a powerful asset in retirement, but it's also not a liquid asset. Homeowners cannot easily tap their equity to cover the costs of daily life. Your home equity is part of your net worth, but it generates no income unless you find a way to tap into it and leverage the funds. Outside of retirement assets such as 401ks, home equity tends to be one of the largest existing retirement assets. According to U.S. Census Bureau data from 2022, home equity composed 62% of the net worth of people between the ages of 65 and 69. That percentage trended even higher for older age bands, as home equity accounted for 63% of net worth for people between 70 and 74, and 69% of net worth for people over age 75. The home is a large asset and needs to be considered as part of total wealth and as a possible way to generate retirement income. Some people can use it to downsize and reduce cost or free up equity. Others can borrow against it and use those funds to support their spending needs. If you're looking to eliminate mortgage payments, access additional cash flow, or purchase a new home, you may want to consider a reverse mortgage. Tapping into home equity through a line of credit or a reverse mortgage during a down market can also help provide needed cash flow to meet spending needs in retirement in lieu of selling investments in a down year. The home equity conversion mortgage, HECM, commonly known as a reverse mortgage, is a federally backed loan. It's a legitimate financial product designed to allow older homeowners a way to access the equity in their homes without monthly mortgage payments. There are rules and guidelines, including who's eligible, and the truth is that a reverse mortgage isn't right for everyone. But for those who are facing specific challenges, may have certain needs, it may be the solution they've been looking for to help increase cash flow in retirement. The truth about making disciplined financial decisions, as well as attaining your financial goals that you may have, is that they're solvable with the help of a financial advisor. There are a lot of places where people seek financial advice or guidance on personal finance. The thing about personal finance is, well, it's personal. And if you want your plan to be personal, it has to be tailored to you. It's never too late to create a plan to give you the financial security and freedom that you deserve. Take control of your future and schedule a no-obligation consultation with one of our advisors today. Go to www.makeitpersonalpodcast.com to learn more or to connect with one of our advisors, download our ebook, or to subscribe to our monthly newsletter. Also, please like and subscribe to the podcast. Do you intend to pay off your mortgage before retirement? Why or why not? If you're watching or listening on a platform where you can comment, please do so, as we're curious for your thoughts. At Mutual of Omaha Advisors, we understand personal finance is personal and financial well-being is essential to achieving your life's goals. Our vision is for every customer to be able to imagine, plan, and secure their financial futures. Make it personal. It's your money, it's your plan, it's your future.
This podcast is for educational purposes only and may include references to concepts that have legal and/or tax implications. Mutual of Omaha Investor Services, Inc. does not provide tax or legal advice. Please consult with the appropriate professional regarding your personal situation prior to making any financial decisions. Strategies discussed may not be suitable for everyone. Securities and advisory services offered through Mutual of Omaha Investor Services, Inc., member FINRA SIPC. Mutual of Omaha Advisors is a division of Mutual of Omaha Insurance Company.